Hello and welcome to another Property Solvers podcast. This is Ruban Selvanayagam from Property Solvers. I'm here once again with James Durr. How are you, James?
I'm good, Ruben.
Good. Today we're going to be talking on the topic of how to invest in UK property with little money or no money down. And before we get going, I'd just like to preface things by saying that this is not financial advice. And obviously, we'd strongly recommend doing your own due diligence on any of the strategies that we're going to be discussing today. And obviously, paying close attention to what you're paying out and all that kind of stuff. We're going to be kind of exploring a few different areas in today's podcast. And the first one I wanted to talk about was crowdfunding. So crowdfunding and property crowdfunding has existed for, I would say, a decade or two in the UK. Probably got some real traction about 10 years ago. In UK property, there's quite a few that have appeared over the last kind of 10 years or so. And a number of them have fallen by the wayside. The two most recognized platforms, I think, out there are Simple Crowdfunding and Crowd Property. They seem to be doing a number of transactions on an ongoing basis. So just to kind of outline, you've got two different types of crowdfunding. The first is peer-to-peer loans, where you can get a fixed return over a set period of time. Typically that's going to be over the rate of inflation, but it's something that you'd have to check with each platform and each particular deal within that platform. And there's also equity crowdfunding within property projects, where you essentially buy shares within the company or special purpose vehicle that's raising finance. So I believe both Crowd Property and Simple Crowdfunding offer those. Maybe not Crowd Property, I need to check that. But those are the two different types of returns that you can get. So James, what's your kind of understanding on crowdfunding, and has it ever been anything that's appealed to you?
Yeah, it definitely appeals in the way that, like, once you've got a track record with these crowdfunding platforms, you can scale up really easily. It tends to be like it may be a little bit slow at the start to raise the money for a project. So you'll upload your project on there. If you're just new to the platform, like I said, investors on there will want to see somebody with a track record. So at the start, you might either need to pay a higher rate of return if you're borrowing the money, or perhaps give a greater equity share of the deal if you're looking to split the deal with an investor. But when we looked at it, I think there was a few problems. Like one of the issue for us was, like, we need super fast finance. If we're buying properties, like we deal with a lot of motivated sellers, and typically we need to complete in 2 to 4 weeks. So for us, if we needed finance that quick, all the processes and the sort of background checks and the due diligence that needed to be done on these crowdfunding platforms just made it fall a little bit outside our timescales. And when we looked at the actual interest rates that you end up paying on the loans through these platforms, they were broadly in line with bridging. So in the end, like when we were looking sort of a few years back to fund some more deals and scale up a bit, we decided that bridging was a better option for us. But definitely, I know, like, there's a number of developers that use the likes of Crowd Property. And like I said, the great thing about it is once you get one investment done and the investors paid back, the next one will fill up really quick, and then you can scale and scale and scale. And it's great for developers who want to do that using the platform, So it definitely has advantages. And obviously for an investor who doesn't want to manage a property themselves, they've got the advantage of maybe they can do like a small investment in a project for a small percentage. And also they can just lend money to somebody who knows what they're doing. So they can slowly maybe learn about the project that way. And a lot of these developers will do a sort of an invest and learn program where they'll sort of take you on the journey with them. So it could be a good like sort of first step into property development for a lot of people who are not really ready to take the plunge themselves.
Yeah, you can learn about the whole process really from how the project has got planning right through to kind of completion. But what I would say is it's important to check the credentials of both the directors of the platforms, but also the individual developer. As you said, some of them may not have a great track record, and you're probably better off being a little bit more cautious about those kind of developers because they haven't got the right kind of experience for you to invest a huge amount of money. But then also check the merits of the deal as well. Like do your own due diligence
Yeah,
on
every
properties that are being developed. Yeah.
I guess everyone on there has to start somewhere, right? So just because they don't necessarily like have a track record on the platform, I mean, it doesn't mean they're bad. They're necessarily bad. But obviously, as Ruben says, I mean, if you can't see what their track record is there, you just need to exercise a little bit more caution, and maybe you might look for a higher return to compensate for that higher risk.
Yeah, because I mean, some people might have found a great deal, for whatever reason, but they might not have the experience, which is why they've gone to the crowdfunding platform in the first place. So you might see that there's a great opportunity there, but then you need to make sure that you're adequately protected for the risk that has not got the right kind of experience. And also,
I mean, I've also
sorry, James.
Sorry, go on, Ruben.
Yeah, I was just going to say, speak to other investors as well, because they're effectively networks themselves. A lot of these platforms, the Crowd Property, they've been around, I think, for at least 10 years now. So there's a lot of people that have kind of invested in their projects. So it's worth speaking to other investors that are regularly involved. Checking their reviews as well. Trying to speak to other people that have been involved in their projects, because I do know. I think you mentioned something about, James, where you can. With Crowd Property, I think you can invest in a project and then kind of take that investment and reinvest it into other projects. And I do understand they have like quite a big waiting list for some of their projects as well. So it's still worth speaking to other investors who've been involved in projects in the past, and to discuss their experiences as well.
I mean, on the flip side, I have also heard from property developers and business owners who've used crowdfunding to fund their projects or their businesses. And the feedback from that has sometimes been quite negative, in that it's a nightmare dealing with so many different investors and keeping so many people happy. And some of them have just said that, like, after trialing it, they decided it was better just to deal with one investor, or you know what I mean? In the case of a company, maybe go down a different route like VC funding or whatever. But obviously that depends on the deal and, how you arrange the particular setup if you're going to get one of your projects funded on there.
Yeah. And I guess if you're a small investor investing in a project, you're still kind of interested in seeing what happens. So you're going to be asking questions to see what's going on. And the developer might not be up for sending individual emails to each small investor, So it could end up being a bit complicated, I imagine.
Yeah, I mean, you could have 100 investors on a project. I mean, it sounds like an absolute bloody nightmare to me. But like I said, when we looked into it, it just didn't suit our particular criteria about what we were looking at from a finance provider. But it's everyone, each to their own. And obviously, if you want to sort of get involved or start out in property, and maybe you just want to dip your toe in the market, you can start there.
Yeah, I think, as you say, it's a good way to learn, about the industry without too much risk, because you're not getting fully involved in these projects. You're kind of taking a little slice, but still kind of getting involved and dipping your toe in the water. Okay, so the next one I wanted to talk about were real estate investment trusts, or REITs. These have.
How you're talking, Ruben.
Yeah, I mean, I was going to let you kind of take the reins on this one, James, because I think
I let you actually, Ruben, take the reins on this one.
Well, let's see. I mean, I've done a little bit of research.
I don't mind. Look, we'll make this extremely quick because none of us are experts on real estate investment trusts. But as far as I understand, a real estate investment trust is very similar to an index fund. But like an index fund will usually have individual stocks, whereas a real estate investment trust will have various, like they'll invest in various commercial buildings, property developments, anything to do with property, and it's all wrapped up in a real estate investment trust. They pay, like, I mean, even I think they pay a return based on how the fund does. So it's exactly similar to an index fund. Gives you some exposure to property in a diversified way. I'm certainly not an expert in it. I believe Ruben is. So Ruben, you can.
I wish. So yeah, I mean, I've done some research on this, so that's pretty much all I've done. I've never got involved myself. I mean, if you want to go and have a look at what UK REITs are available, you can go to goodmoneyguide.com/analysis/UK REITs, UK-REITs. So yeah, you do have these equity REITs that own physical properties, and the investors earn money from renting them to individual. So the fund effectively invests in them, and then they're rented to individuals and businesses, and then shareholders get paid out in the form of dividends. So they're normally publicly traded and can involve residential, commercial, hospitality. You know, a range of different kind of investment structures can be kind of involved with this. You also get mortgage REITs, as well, and
they don't necessarily. Sorry, Ruben. Go on. I interrupted you. Sorry.
It's all good. It's all good. But yeah, I was just going to say you also get mortgage REITs as well, and these are funds that buy mortgages or mortgage-backed securities, and they earn income from the interest on the mortgages they invest in. So yeah, just to kind of outline the different types of REITs that exist. You've got healthcare REITs, you've got office REITs, which I think are taking a big hit at the moment. Residential REITs, the institutional PRS is an example of those. Industrial REITs, so things like warehouses, distribution centres, these kind of e-commerce type buildings and properties that exist. Retail REITs, so shopping centres, again, I think they're taking a big hit at the moment. Grocery stores like supermarkets and things like that. So there's like also infrastructure REITs as well, like telecommunications, energy pipelines, wireless infrastructure. So, there's a range of different things that you can get involved in. Again, it just comes down to doing your due diligence. And I think that they can be quite volatile. So really kind of, check them out and look into them. Something that if I had a bit more time, I'd probably do myself, because it's property and I'm interested in property. But yeah, unfortunately, time's against me at the moment. So yeah. So what were you going to mention about them, James?
Just that they don't have to be always based on rents. I mean, REITs could be just funds that invest in projects, like development projects, it's really, it can be anything property related wrapped up in a REIT. But I am quite impressed with your knowledge there. It looks like you've done a bit of research.
It's called Google and ChatGPT. Okay, so we're going to move over to some kind of like micro strategies. So talking about going out.
Let's get into the real.
So those are kind of broader strategies if you want to just find out a little bit more about property investing on a kind of wider scale. If, for example, you just you're going to networking events, for example, you're coming across properties, you're really interested, you're going out there, you're perhaps doing some direct to vendor marketing, which we talked about recently on the podcast. You're coming across properties, but you just don't have the capital to be able to invest in properties. We're going to talk about a few different strategies now. So the first one is borrowing funds from friends and family. So this is kind of one of the main ways that a lot of people get involved in property. What I would say is that, yeah, it's a great way to kind of get some capital. Often, parents, uncles, aunties, friends, family, all interested in property, but they're time poor but cash rich, so they're interested in maybe kind of getting a bit of a return on their money. What I would say, if you're a newbie to property, it's not a case of just taking money from people and just kind of throwing it into a property deal. Make sure you're actually doing your homework and finding deals that have got real merit, so you can kind of present them to your friends and family in a in a way that's kind of convincing that they're actually going to get something out of it. And I would also say, even though they are your friends and family, do everything in a kind of, a legally watertight manner, trying to, do structure things in the right kind of way that kind of protects their funds. Because a lot of times they would have built that capital over a long period of time, perhaps your work, or, it could be their pension savings. So they need that money eventually, so it's important that to realize that even though you're taking money from friends and family, you should do things in a way that you're limiting your risk in the best way possible. What are your thoughts, James?
Yeah, I mean, it's a good place to start if you need to raise money. I agree, use contracts where possible. And yeah, not really to add to that, really.
Okay, sure. So the next is borrowing against your own property, your own home. So, it's fairly common for people to do that. So effectively, if you purchase your own home to live in, to buy properties, you can effectively remortgage your property. Obviously, it's a lot more difficult now to release equity from properties because rates have gone up. Lenders are being stricter on what they would be willing to kind of leverage a property up to. And also, there's the ongoing risk of refinancing, so the fact is you're borrowing more and your interest payment is going to be higher. So you are going to be exposing yourself to a certain degree. What were your thoughts on that, James, on kind of borrowing against your property? I guess it depends on how much equity you actually have. If you're pretty much close to having an unencumbered property, maybe there's leverage to, there's leeway to do it more confidently,
Yeah.
Yeah.
I mean, obviously the great thing about remortgaging is all the money's tax-free. And if you start paying taxes from selling property, you will start quickly realize how great tax-free money is. Because bloody hell, like right now, selling properties, we're getting absolutely hammered on capital gains tax.
Yeah.
And refinance is how myself and Ruben were able to aggressively grow our portfolio at the start. So I'm 100% behind refinancing. Obviously, you can't be stupid about it. You need to look at like what your monthly outgoings are, what your income or like what your salary are, whether you can afford to pay the extra mortgage repayments. Because obviously, when you take more of a loan out in your house, your mortgage repayments are going to go up. So obviously, you need to make sure that you can still pay the extra mortgage repayments and all the outgoings that you have already. But if you can do that, then I think it's a great way, especially in the early days, to get going. Like when you've got no or very little money. Not all of us have been born with a silver spoon in our mouth, so you got to do what you need to do to be able to raise the money, to start out in your property journey.
Yeah. Just be careful, is our advice. Make sure that you're not going to overexpose yourself because you don't want to get into a bad situation with the lender. Remember, I know we spoke a few weeks ago about repossession and mortgage arrears. Remember, the lenders aren't going to be as lenient with you if you're refinancing against a buy-to-let property. They'll come after you a lot faster, and they won't be as nice, put it that way, if you do default or go into any kind of mortgage arrears. So yeah. Okay, so the next one is purchase lease options. So James, do you want to maybe give a little bit of a broad overview of what purchase lease options are and how people with little capital can maybe get involved with that kind of strategy?
Yeah, purchase lease option, or maybe rent to buy, as it's also known as. So that would be where there's several ways that you can work it. But basically, you get an option to buy a property. So let's say, for example, Ruby, you come to me with a property at 100,000, and let's say you just want to get rid of it. Let's say you're a tired landlord. It's worth 100,000. and you're renting it out. Let's say you're renting it out at 450 a month. I'm just making up random figures here for the purposes of the example. So say you're renting at 450 a month. I'll say to you, and you want to get rid of it, I'll say, okay, Ruben, I'll buy the property from you. But what I want to do is I will, like, let's say you can't get finance or whatever, or let's say that you, Ruben, at this point, you owe 100,000 on the property space, so you got no equity. Can I still make a deal work? Right? This is sometimes a typical situation that you'd use a lease option. So I could say to you, Ruben, okay, I'll take over the debts of the property. Let's say the mortgage on this property is 400 a month. So you're just breaking even on your 450 a month after costs, maybe even losing money. And I say, okay, what I'll do is I'll take over the mortgage repayments on the property for a period of, let's say for this example, 5 years. But I want an option to buy this property at 100,000 that I can exercise within the option period. So basically, any time within the next 5 years, I can buy that property for 100,000. Meanwhile, what I look to do is, say, for example, if you've got the rent at 450, I might say, okay, I know that like there's 3 bedrooms and let's say a lounge and dining room in this house. I know by changing that from a single family home to a 4-bedroom student let, for example, where I can rent the rooms at, let's say, 250 a month, as an example, right? So instead of 450, which you've been getting currently, I know that I can get 1,000 a month on this property. So I'll get the contract drawn up and I'll pay an option fee, and the option fee can be as little as £1 sterling. It just needs to be a nominal amount to secure the option price and make it legal. So I would say I have a 5-year option to buy this property at 100,000 with the option price being £1. In the meantime, I take over all the financial responsibility of the property. I basically own the property. You, Ruben, can walk away. You can forget about the hassle of the property. You know that I'm paying the mortgage. And then...
Joe, just to interrupt there, how would I know that you're paying the mortgage, and how would I know you're not going to screw me over and just stop paying the mortgage?
Yeah, I mean, I could ring up the lender and just say, look, I'm responsible for the mortgage, and get something off the mortgage lender just to say, like, that, you know, you'll be notified if I don't pay the mortgage.
Right. Okay. So the lenders usually don't mind this. Are lenders okay with this, or do they ever kind of say, look, this is not what we agreed to, it's not in our T's and C's?
No, the lender will be fine as long as their loan is getting repaid.
Right.
Yeah. So just going back to the idea behind the 5 years. So, like, obviously, this sort of a deal right now maybe mightn't be as attractive as it was, like, let's say in 2012, when we're just entering into a rising market. Like, it depends what your thoughts are in the market, but basically the idea would be within the 5 years, hopefully this property will have increased in value. So let's say at the end of the 5 years, let's say it had worked out and increased in value and it's worth 130,000. You could then exercise your option at the end of year 5, buy the property at 100, resell it or refinance it at 130, in which case you've made 30 grand in equity or cash if you sold it, as well as making £550 a month before costs, for the whole 5 years that you've done the lease option with the old owner.
Right.
So that's the basic idea. And there's several ways you can cut it and twist it, but so yeah, the idea is to control the asset without owning it.
Without owning it. So effectively, could you say, for example, you saw a property that is prime for HMO redevelopment. So you've seen let's call it like a 3 or 4 bed, semi-detached house, a good location that would work for an HMO. Could you take that property, take it on an option, do what you need to do, you know, get the licensing sorted, reconfigure it, etc., and then still take the option of it? Would you, if, for example, you decided to not exercise your option, would you need to return it back to the owner in the original state that it was in once you've done all that? I assume that would be the case, right?
Yeah. Yeah, I mean, this is something that you'd have to agree with the owner, and obviously the owner is going to want their own protections. Like obviously the longer the option period, maybe the owner might want more money up front, you know? So all these figures can change. And you can also remember an option is not just for property, you can do it with land. So say if you find a little bit of land that you're looking to get planning permission on, you could take an option to buy that land at the pre-planning price or valuation, say take it on a 12-month option or an offer subject to planning. And then at the end of the 12 months, once you've spent all the money, like with your architect's drawings and getting it through planning, and you've managed to get planning on it, let's say it's a plot that you've managed to get like 10 houses on the plot, like obviously the value of that land will shoot up significantly as a result of it having planning. So obviously through using the option agreement and controlling that piece of land, you can benefit from the uplift between the original option price at which you secure the land and the post-planning valuation. And you can then either sell it on or build it out or do whatever you want. But again, you're able to control the asset. In this case, the underlying asset is land. With, you know, often very low money down.
Yeah. But I guess the most secure way of doing it from a seller's perspective is to exchange. And you can exchange again for a normal amount of money, but you give the vendor a little bit more security doing it that way, I'd imagine. So exchange is probably
100%
up, right? From options.
Exchanges are similar. I mean, but both of them are similar sort of contracts, but the exchange is more legally binding.
Right.
The exchange will have a completion date that either you can get an assignable exchange, right? So I could exchange on a property. If it's an assignable exchange, I could assign it to somebody else, but that person will still have to complete within the frame that the exchange states.
Yeah.
So again,
to another buyer.
100 grand.
Yeah. Sure.
So if I find a seller with a property for 100 grand, and let's say I know I can property at 80,000, let's say I do an exchange contract, an assignable exchange contract with owner A at 80,000, and let's say I sell it to you, owner B, at 100,000 on a assignable exchange, I can take the difference. So basically, I'd make £20,000 from just getting a contract with one person, flipping it to another person, and I never actually own it, even though I am the one who's exchanged. So that's actually a popular strategy right now with a lot of property traders do that.
Yeah.
Yeah.
Sure. And just to kind of wind things up, what's vendor finance? How would you describe what that is? How does that work?
So vendor finance is effectively when the vendor becomes the mortgagor for their own property. So instead of me, let's say, Ruben, you can't mortgage from the bank. And so you decide, let's say that the interest rates, actually, this could be a really good strategy at the moment because interest rates are so high. Yeah. So say, for example, you quoted like 6%, 6.5% interest on a bank loan on a 25 on a 25-year mortgage. And let's say you found somebody, let's say they're close to retirement, say 65, for example, and they've got a property that's worth, let's say, 200,000 in this example, or we'll just use 100,000 just to keep it simple, like our other one. So they got £100,000 property, and all they want from the property is income, right? So they just want to forget about the property, have it rented for like 10 years, for example, completely forget about it and just take that income and have it top up the retirement. So they could to me on owner financing, and I could say to them, okay, instead of me going getting a mortgage, would you be willing for me to buy it from you at, let's say, 500 a month, and it's payable over 10 years?
Right? It's a repayment mortgage.
With a balloon payment at the end, for example.
Yeah, so it's a repayment mortgage to...
A repayment mortgage, effectively.
Yeah.
Yeah, so for them, okay, they're not a large sum up front, but you can give them a large sum if you want to structure it that way. Mm-hmm. But the idea for them is, let's say they don't get a month anyway. This way, like, they're getting 500 a month every month, and you're getting to pay the property off interest free. Now, obviously, the owner might want a little bit of interest, but for the sake of argument, let's just say they're happy a month. For 10 years.
Can you say that again? You cut out.
And then with the remainder paid.
Can you say that last bit again? You cut
sorry.
Out a bit there,
yeah. So let's say I pay 500 a month, right? That's $6,000. I pay that for 10 years. That's 60,000 they get over 10 years. And then with the 40,000 balloon payment, I make that payment in one go at the end of the year, and that pays it off completely.
Right.
I mean, what I could also do, I could also say, instead of doing the 40,000 at the end of year 10, I could do it up front. I'd say I'll do 40,000 now, and then 500 a month for the next 10 years, for example, you know?
Eventually all off.
So, what's that?
Eventually clear the entire debt off. Yeah.
Yeah, you clear the debt off, and you're just effectively using the vendor as the mortgage company. Obviously, it means that between the two of you, you can come up with terms that work well for both of you. This is more common in the US, I think, than it is here, really.
Yeah, for commercial.
But it's definitely something that's worth considering, particularly now, with the way that the mortgage market is.
Yeah, sure. Well, I hope that's helped. Hopefully given a few different tips and pointers there, all at kind of levels. Again, we very much welcome your comments and feedback. If you've got any topics that you wish us to discuss, please get in touch. Feel free to reach out to myself and James on LinkedIn as well. And we're always happy to have conversations with people. And yeah, thanks again for listening, and please like and subscribe. Really appreciate it. Take care. Thanks
very much, guys.
Bye.